Good day and welcome back to the F Word Finance, where we discuss everything that's happening in the world of finance. And I'm happy to have my brother and colleague back from holiday. PJ, welcome back. It's back to work, back to school, and we're ready for an exciting year to see what's happening in the financial markets. Talk about excitement. Towards the end of last year, you said they are expecting a Santa Claus rally. If we look at the history, there's normally a Santa Claus rally in the markets towards the end of the year. And indeed, it did happen, especially in the US, but not just towards the end of the year. It was actually the whole of last year. So I saw an interesting chart, which I definitely add into the comments. And they first looked at what was the prediction at the start of January. So they went to all the big banks, all the big asset managers in the USA. That's well-known names, people that's highly educated, very clever people, big teams of people, and they said, "What are you estimating the growth is going to be on the S&P 500 for the year 2023?" Keeping in mind, remember 2022 was a terrible year in the S&P. I think it was down about 20%, PJ. And then what was the expectations for the year? And it was a big range. People varied from -4%, expecting -4% growth, up until 27%, the one bank also mentioned. But average was between 5 and 10% growth they are expecting on the S&P 500 for the year 2023. And then we saw towards the end of the year, it was up close to 25% for 1 year. And PJ, once again, we saw towards the end of 2022 people get fearful, and then we see people running to the money market, people running for safety, which is once again the worst thing you can do at that point in time. But we see it every year. Every time there's a drop in the market, people run for safety, they act on emotions. And I think this was once again such proof that that's the worst thing you can do. And like you also said previously, be fearful when others are greedy, but being greedy when others are fearful. Don't follow the flock and now run to safety, because then you would have lost out on this 25% growth. People say they're going to wait till I see the market coming up and then I'm going to time it. And we know you can never time the market. It is about time in the market. And once again, this was such a good example of that. You can't act on emotions. And once again, that's where your financial advisor should be assist you, because he looks from an outside point of view. He takes emotions out of the situation, and then he would have told you, now is not the time to get out of the market. We stay put, and that you would have had the 25% growth. BJ, once again, if we look forward, they're again predicting about 5 to 10% this year. We know it's going to be a volatile year. There's lots of elections going on around the world. In over 40 countries, there's elections taking place. So it is going to be a volatile year, but you can't act on emotions, because then definitely you are going to lose out on these growth years.
No, thank you, Joe. I think the quote of the year for me, I read this on Twitter, is that volatility is normal. We don't like it. We don't like when the big falls and everything, but it's part of the market's nature. So if you're a long-term investor, you have to go through that. So we have a lot of clients that say we're going to wait, like you said, for it to recover when interest rates going down. But the problem is the market is always forward-looking. So why the rally was so big, even before interest rates was um, went up again, is because they are expecting that it's going to happen, that they are going to lower interest rates in the future. So, and if there might be a recession yet, we are not out of the woods quite yet in the USA. So there might come, the earnings might come down, and then we can see a big drop again. Maybe in the beginning of the year, we can see a drop in, especially in the US markets, what's expensive. South African markets is relatively cheap, and emerging other markets. We're not the only market. So we won't fall that hard than the US can. So that's going to be an interesting year. But again, I can't tell you what's going to happen in the next year. Then it's better to be in cash and income funds. But if you've got a long-term horizon, especially in the South African market, if you have a view of 2, 3 years, it's you can sit quite nicely on SA equities and other emerging markets at this stage. Anyway, so that's very interesting, but that's not totally in our control. But one thing that is in our control is tax planning. And I think a lot of people say the best time of the year is Christmas, but for a tax practitioner, the best time of year is this February. Um, January, February, because there's a lot of tax planning opportunities that you can use. And we always talk the big one that we can use, because if you're a salary earner, unfortunately, there's not a lot of tax benefits you get. You get a small deduction on a medical aid, and maybe you get a travel allowance. But otherwise, the only thing you can do to get money back from SARS, your own money that you paid, um, being paid back to you, is in saving in a retirement annuity fund. And why this is a good time of the year for tax planning is because you can see, okay, what's the money that I did earn? What's the calculations? Did I make big capital gains transactions? Did I earn a big bonus? Do I have extra money that I can put into a retirement annuity? And that's definitely where we assist clients to use that. So a lot of people say don't invest in retirement annuity in SA, but we know we always talk about it. You can invest in the SA market. You get a broad, diversified range all over. You can have up to 45% offshore, and if you're still going to retire in South Africa, it totally makes sense at the end of the day. But the tax benefits is quite used. So you can look at your own benefit. Every rand that you can contribute, if you're a high income earner, you're close to 40% tax rate, you get 40 cents back. And you can do that up to 27.5% of your taxable income, or the max is 350,000 rand for the big earners. So that's definitely something you have to look at. And why it's important now, you can only do that up until February. After February, you've lost that. So that's definitely something that you need to look at, retirement annuity. And the other big benefit that a lot of people don't realize, there's no tax on the growth of the investment. Let's say if you put that money into a money market, it's safe. You just have to remember you get taxed on that interest. If you invest in a share portfolio, you get outside of a retirement annuity, you get taxed on the capital gains. While in a retirement annuity, you got that tax benefit, and on the growth of the assets, you don't get taxed. You only get taxed when you retire and take money out of that, when you aren't on a big tax scale anymore. So a lot of people said, well, then I pay tax, but then you can manage that. So most of our high net worth clients understands the tax, and if you don't understand or have any questions, please let us know. I think it is very important to be educated about this and not just follow people that's negative and slam things, and they don't take into all the considerations, especially in the retirement annuity, and you lose it out. If you lose it this year, it's difficult to catch up because you only get 27.5%. With that being said, the other bigger one that you have to look at is the tax-free savings. Um, I try to max mine in the beginning of the tax year, March. If you don't have money, take a bit out of the bond or out of your flexible investments and put it into a tax-free savings, because that's a big benefit. And you only get 36,000 Rand a year. It sounds, for some people, it's a lot of money. For some people, it's not a lot of money, but you have to use that 36,000 Rand each year. And if you don't use it before February again, you've lost that contribution. So then you have to contribute the next year 36,000. And we had one client, the taxes, it's not an investment client because we would have advised otherwise, but they contributed more than 36,000 Rand that, into two different tax-free savings accounts. And you actually get taxed 40% on that amount that you contribute over 36,000 Rand. So that's very important thing to look at when you do that. And again, you don't get the like retirement annuity tax back from SARS on the contributions you make, but the growth on the investment don't get taxed. And for now, it doesn't sound quite big, but the point is you want to make a lifetime contribution of 500,000. That's the max at this stage. Hopefully, they lift that in the future. So you can do every year 36,000 Rand up until a lifetime contribution of 500,000 Rand. But that's where the magic happens. If you've got 500,000 Rand there and it grows to 1.5 million Rand over a 20, 30-year period, when you withdraw that, there's no capital gains tax or no interest or anything like that. So that's why we recommend also more aggressive type investments. It's a long-term investment vehicle that you can use. What I use and recommend normally for clients is for to supplement your retirement or to save for children's university fees and things like that. Joe?
Thank you very much, PJ, and I'm happy to see that you are so happy to talk about tax. It's so exciting to talk about tax, and you must have had a boring Christmas if tax season's happier time than Christmas. But no, thank you for that. And once again, very important point you made there is people look at the returns, so then they want go to money market and they say, well, the bank or the money market give me 10%. But if you take the tax implication into consideration, and that's what a lot of people only realize now when they need to do their tax, or because there's a big sum amount of money in their bank, now they start paying interest on that, all the interest that they made. They start paying tax, and so the returns are not 10%. If you take the net return after tax, it's closer to 5.5%, 6%, depending obviously on how much you earn during the year. Very important. Two great examples that you mentioned there, but also if you have lots of money sitting in the money market or in the bank, lots of tax you can avoid by placing it somewhere else. And you can still keep it conservatively. There's other options to invest your money conservatively. It doesn't need to be in the bank or into a money market account. Thank you, PJ. Yeah, it's about a month and a half left of tax season. So make sure you speak to your advisor. Please send us your questions if you do have, and we would be glad to answer them. Until next week.